All right. So I'm Marcel Petitpas, CEO and founder of Parakeeto. Basically, what I do is I help agencies run more profitably. I don't do their accounting, though. That's Ryan's job. So we'll defer to him for all of that stuff. But I help you figure out what makes you money and how to do more of it and how to do it more efficiently so you can do more with less time, which is the name of the game in the agency world. And what we're going to talk about today is the difference between pricing and scoping, how to think about those things, and what you should be thinking about as you go through the process of scoping projects and pricing projects, or coming up with your pricing if you're more of a productized agency, how to think about the strategy, how to think about the contract terms, and really develop a strategy for yourself to make sure that you're getting the right margins for your business and setting yourself up for success in that area. So that's what we're going to cover today. We'll talk about the difference between those two things, how to land on the right pricing strategy for you, how to think about setting targets for margin and what the signals you should be looking for through that process are, as well as how to get accurate scopes of work and create the right feedback loops to make sure that you're tuning that over time. And that's really what we're going to cover today.
Awesome. And we'll have some time for a little bit of QA at the end, but we're scheduled for, I think, 20 to 30 minutes actual presentation, and then we'll open it up. But Ryan, introduce yourself real quick, and then you're going to be leading the next session, and then back to Marcel, and then Ryan again at the end.
All right, Ryan, owner of Knoll Solutions. Yeah, like Marcel said, we're a small accounting firm. We help creative agencies, and by help, that's anything from day-to-day bookkeeping, running payroll, paying your contractors, to kind of the bigger, longer-term strategic planning and budgeting, thinking about pricing and KPIs and other things like that. I'm going to be doing this session, I think, in 2 weeks. The next one on accounting and billing systems. And so this is going to be a little bit more of the nuts and bolts. The day-to-day is like, okay, what software should you use to do your accounting? What does your tax accountant need at the end of the year? Are there good tools and software to use for payroll and accounts payable? And then how to make all those things talk to each other and interact. Some of them do it natively, but then some of you need to kind of build some things in on top of it just to make yourself more efficient, to spend less time on this type of stuff.
Love it. Yeah, we've got you both here because you cover different and interesting areas of the same topic, agency finance, bookkeeping. So we'll bow out of the spotlight. We'll let Marcel here take it over and dive in.
Go ahead and share my screen and we'll dive in. So we'll start with the first fundamental question here, which is, what is the difference between pricing and scoping? And why should we be thinking of those things as two completely separate exercises? And the way I think about this is, pricing is about what you get paid. What you get paid. And how to think about asking the client for the right amount of money for your work. And this is really just about income. Whereas scoping, I like to think about this as what you're going to spend. What you're going to spend as it relates to what you're getting paid, right? So in the agency world, the unfortunate reality is that it costs money to make money. And when you close a project, either you or somebody on your team has to spend time getting that thing done so you can earn that revenue, and you make sure you don't have to refund the client or give that money back or what have you. And so this is kind of how I separate these two things. The pricing exercise is what you're doing for the client. And this is something that you're doing really for yourself as an agency. And your pricing strategy and your scope of work, they might be related depending on what your pricing strategy is, but they don't necessarily have to be. And what you do internally does not have to be the same set of documents, the same set of lingo, the same set of targets, the same set of conversations that you expose to the client. In fact, I would argue that those things should be very different because they serve very different purposes. What you expose to the client is in service of helping them get a solution to their problem and getting that within a budget and within a timeline that works for them. What you do internally has everything to do with making sure that you can get the right people working on the right stuff so that everyone is working a reasonable amount of hours, they're getting the project done efficiently, and you still make money at the end of the day so that you can keep them employed and keep everyone happy, keep working with your clients, etc. So let's talk through the first thing is how to pick the right pricing strategy for you. And there's a lot of buzzwords that fly around with pricing, but there's basically three ways to price. You can price based on time and materials. This is kind of the old agency world. This is what you're familiar with from agencies of the past, where it's, we work an hour, we charge you for an hour, we have an hourly rate. That might be the same hourly rate for the whole organization. It might be different based on who's doing the work. It might be different based on what type of work is being done. But it's a very simple model where we log an hour, we charge the client for an hour. And there's lots of different ways to do time and materials billing. We can charge an hourly rate, we can charge a daily rate, we can charge a weekly rate. But the basic principle here is it's a function of time, and we charge for a certain amount of time. The other way to think about this is fractional teams. We're seeing a lot of this pop up in dev shops, especially ones that are working on larger projects, where we're saying we're going to give you, the equivalent of 2 developers and some oversight and some design, and we're going to charge you $10K a month for that. And so you're basically leasing a team at a fixed profit margin. The other way to think about this is more of an abstracted model. So an example of this would be there's an agency I know of now, their name is escaping me. It has the word penguin in it. They do a good job of this, where they have like a credit system. They've kind of created their own currency, where it's like you buy a certain amount of credits and then you redeem those credits for certain deliverables. But on the back end, they've got the math to understand what does a credit actually equate to in an hour, so that they know what their margin is, generally speaking, on that. So these are all different ways to think about time and materials billing. The other 2 ways to do it is charging flat fees, which is often conflated with value-based pricing, but that's not necessarily the same thing. So that's just saying this costs X amount of money, either per deliverable, per website, per blog post, per whatever, or it's this much per month, and these are the deliverables that you get within that. So that's more of almost like a productized service. You're charging a flat fee, and it doesn't change depending on how many hours you work. And this is a good way to start the separation of how much time you invest versus how much you ask the client for. And then the final idea is something we like to call value-based pricing, which is another iteration on flat pricing. But really what you start to try and do there is create an association between what value the client is going to get and how much you're charging. And you're completely separating that from how much time it's going to take you to get that work done. And so the simple mental model that I use to help our clients understand where they should be thinking about creating a pricing strategy is thinking about these 2 axes. The first is, how much risk is there in the project? And when I talk about risk, it's about risk in scope, really. How easy is it to predict what the scope is going to look like? How much risk is there that the scope is going to change as the project evolves? And so an example of this would be if you build custom software for large enterprise companies and you're working with technology often that you've never worked with before, you're building integrations with products you've never worked with before, then you're going to be super high risk. Any developer will tell you it's basically impossible to figure out how much time this is going to take. The margin of error is going to be very, very high. If you're low risk, this is like, we build websites off of this one template for this one market, and 90% of the websites are the same. We've done 1,000 of them. We know exactly how much time it takes us to within a very small margin of error. It's a very productized service. It's very predictable. That would be an example of a very low risk type of service. And so that's the first axis to think about. The second one is the value axis, right? Are you doubling the conversion rate for a company that sells 1 million products a month, therefore taking them from 1 million to 2 million products sold? Or are you doubling the conversion rate for a company that sells 10 products a month, taking them from 10 to 20? The value of what you do for that company, relatively speaking, is very different. The company with 20 products being sold is probably not going to pay you as much as the company that's selling 2 million. So think about what is the relative value of what we're doing and how that might impact what somebody is willing to spend to get their problem solved. And typically we think about this in terms of, SMB, that's the simplest correlation, versus, enterprise or large businesses. So if you are doing a lot of projects that have high risk and low volume, you're probably going to be doing some variation of time and materials billing here, because again, you're having trouble predicting how much time it's going to take you, and it's relatively low value work. So you're probably going to be squarely in time and materials. The same thing goes for high value versus high risk. But the difference here is you might start to shift to methods of time and materials billing that are going to be on longer time horizons, or that are going to be abstracted from the hour a little bit more. So maybe you're talking about charging for sprints, charging for weeks or months of your team's time, charging for a fixed team, or some kind of perpetual engagement in that way. So you're still using time and materials internally, but you're abstracting that a little bit to the client side to try and get their mind out of hourly rates and more in terms of value, while still fixing your margins and while still protecting yourself from all the downside that exists in the scope of this project. If you're high value, or sorry, if you're low volume or low value and low risk, then this is probably where you're going to be doing flat fees, right? So you think about this as productized services. We charge 5K, 10K, 15K for a website. We charge $500 for a blog post. You know exactly how much time that's going to take you, and you're using a flat fee to probably try to arbitrarily bring your average billable rate up relative to what that client would typically be comfortable for if you just gave them an hourly rate on a call. This is kind of an interesting psychological way to sometimes get your average billable rate up without making the client uncomfortable, because you're kind of anchoring it in a flat price. It's easy for them to understand, and it's creating less risk for the client. And you can afford to do that because there's less risk for you. And then if it's high value, low risk, then this is where you're typically going to want to start pricing on value-based, where you're saying, hey, we think that we can create $1 million in value for you with this project, so we're going to charge you $80,000 for that, 8% of that potential upside. And it doesn't matter if it takes you 10 hours to do that or 1,000 hours to do that. That's kind of what you're anchoring the price to. So this is how to think through, just at a high level, what might be the appropriate pricing structure for you. Really think about risk, think about value and the types of services that you do, and find something that's going to mitigate risk for you. So that's pricing. The next thing I want to talk about is what you should be aiming for when you're coming up with a price for a project. And this is related to scoping, because again, what we should be doing in every pricing exercise is actually going back and figuring out what's it going to take for us to get this done, or what do we think it's going to take for us to get this done, so that we can identify our gross margin. And we want to think about gross margin. Your accountant might call this contribution margin. It's neither here nor there. At the end of the day, what's important is how much are we going to get paid and what's it going to cost us to provide this service. And we want to make sure that there's a nice fat margin there so that we can afford to run the business and still walk away with some cash. So typically what we're targeting here is anywhere from 50 to 70% gross margin or contribution margin. So how do we calculate this? Well, we're looking at what I like to call AGI, or agency gross income, which is basically, the simple definition of this is all the money the client's paying you that actually belongs to you. So you take out your Facebook ad spend, you take out the other agency that you're partnering with that's going to deliver this other side of the service, you take out the template that you have to buy to get the work done, and then you're looking at, that's your AGI, your agency gross income. So it's what belongs to us that we need to now earn with our time. And then you want to subtract from that, how much do we actually think it's going to cost us in labor to get this done? So if you're working with a lot of contractors, that's easy. You look at their hourly rate or what you pay them. If it's flat, you take that out of that number. If you're working with more employees, you're looking at their salary plus benefits, their fully loaded costs. And then you're usually dividing that by 2,080 hours, which is generally the amount of time you're buying from them in the employment contract when you hire them at the beginning of the year. You multiply that by the number of hours you think it's going to take them. That should give you a rough cost estimate. And then you can kind of do the math here and figure out where are we going to end up. So that gives you your gross margin target. A simpler way to think about this is average billable rate. So this is thinking about, if we just take the amount of money that we're going to make, our AGI, and we divide it by the number of hours that we think we're going to spend on this, what average billable rate does that end up being? So simple example here, we're going to make $150 an hour when we do the math. And then you can kind of get a directional sense of what your gross margin is by looking at what is my average cost per hour for the people that I hire to do this work. And that's going to be less accurate, but if you're just starting out and you don't have any data points to help you figure out if you're in the ballpark or not, this is a good place to get started because it's simple and it's easy and it'll be directionally accurate. So you do your average billable rate divided by your average cost per hour, and that will give you a sense of roughly where you're landing on gross margin. So this is where you kind of want to end up when you're thinking about how much should we charge. And then when we go through our scoping exercise to figure out how much time it's going to take us, what should the gap be there? So I'm going to pause on that. I'm going to check in with Ryan and see if there's anything you want to add before we move on.
No, I love the previous metric of what pricing method to use. I think that is, from my perspective, I tend to end up with agencies that are value based or flat fees and not the time and material. But I hadn't really thought of it before of like, oh, maybe that's because I'm looking at more low risk projects, and then the high risk too is high risk to you, and so there is a way, doing time and materials takes your risk off the table, but makes it more risky for your client as well. So depending on your clients and how much leverage they have, they might want something that's more of a flat fee and pass that risk on to you, who's like the small agency that, it's more difficult to absorb it. So that's something to keep in mind too, to make sure your time and materials are, and going back to your gross margin, make sure your billable rate is high enough so that you're fully capturing that risk.
I love it. And I just want to add something real quick, or maybe clarify this for me, but what types of agencies would be selling which types of pricing? Like, let's do the typical one, dev shops. Dev shops would be where on this versus a performance-based PPC agency.
Yeah, exactly. So performance based is squarely falls in the value based area. It's a different way to do value based pricing, but that's exactly what it is. You're saying, what's the value of X thing for you, and then you're taking on all the risk of delivering a certain amount of that within a reasonable amount of time, and you get compensated based on that. If you're a dev shop, there's a really good chance you're going to end up in time and materials through some kind of time and materials pricing. It doesn't have to be by the hour. Again, there's lots of different flavors to choose from. But you're typically in a dev shop really having trouble scoping work unless you've got this kind of like very niche productized kind of offering that you've built a lot of code that you reuse all the time. It's a way to get to a place where you're now starting to go more into the value-based pricing realm. But if you're doing a lot of custom stuff, a lot of like very new, never done before type of creative, it's probably going to be high risk time and materials. And then things that we see often being more flat fee or value based would be things like website development, especially if you're niched into a specific vertical or you work on a specific platform. Like we're a WordPress website development agency for legal firms. Like you've probably got a pretty cookie cutter method. It's probably pretty predictable. Same thing for a lot of digital marketing firms. Their process for how they, set up ad accounts and test and iterate and so on is probably pretty predictable. There's probably fairly fixed scope to that. So these would be some examples of things that you'd see being more in the value-based or flat fees kind of region with lower risk on the projects. But really the simple way to think about this is, how hard is it for me to accurately predict how much time it's going to take me to get this thing done for the client? And if you've got a lot of reference points and it's very easy for you, you're low risk. Even if you spend days doing bottom-up estimation and scoping everything out, it still doesn't usually end up being that accurate, then you're high risk. And that's software development in a nutshell, unfortunately. Does that help?
Yeah, no, that's perfect. And, forgive me because I was selling retainers about 3 years ago, but it's been a while since I've done it. So wrapping my head around where agencies are at and what's the main confusion that most agencies have in this whole pricing model scenario. I'm sure there's lots of different questions, but I'll let you continue.
So the next thing I want to talk about is scoping, right? And how should we be doing that? And how should we be thinking about making that more accurate over time? And so the example that I'm going to give here is, it's not the best fit for the most extreme high risk cases where it's like, there is just no consistency at all to what you do. The only thing that's consistent about it is that you're doing it. But like who you sell to, the size of the project, the type of work you're doing for them, the type of problems that you're solving, like it's just always different. In this case, you're doing bottom-up estimation. It's going to be this very arduous process, and you're not really going to be able to benefit from all of the data that your company is creating because there won't be a whole lot of data of correlation between projects, and you won't be able to use them to kind of make the next estimate more accurate. But if there's any level of consistency to what you do, then the method that we recommend is what we call our flywheel method. And really the first two steps that I want to talk about are pretty qualitative. So it's very, very data focused. The first is we want to have an estimation process. So we want to have a process by which we sit down and we think about and write down how much time do we think this is going to take us to do. And we break that down into buckets that align to how we think about staffing that project, right? So are we thinking about this in terms of roles, design hours, development hours, UX hours, project management hours? Are we thinking about this in terms of specific people, right? So ask yourself the question of how you go through resourcing, align your estimate to that thought process, to that structure, and then come up with a process by which you create these estimates that's similar so that you don't have a moving target, and create a standardized structure so that every time you create an estimate, it's broken down into the same buckets, the same line items, and that becomes this kind of consistent foundation. And we no longer have a moving target there. That's super important because the next thing that we want to figure out is, are any of the assumptions that we make when we estimate projects actually accurate or not? The way we do that is we track cost and we track time. So this is time and cost tracking. And the important thing to do here is to make sure that those two artifacts align to each other, right? So if we are saying we estimate this many design hours, this many dev hours, et cetera, when we go into the time tracking tool, it better say, here's how many design hours you spent, here's how many dev hours you spent. Unfortunately, and if you're listening to this might be the case for you, it's the case for like 85% of the agencies that we end up talking to. That's not how it looks, right? Your estimate looks one way. Your time tracking tool says, 6 hours for wireframing, front end UI, thing. And you're like, is that design? Is that engineering? I don't know. And you've got to do a whole bunch of massaging to the data to figure out, was our estimate accurate or not? And because it takes so much time and because it's so arduous, you don't end up doing it. And then you never answer that question of, are we good at estimating or not? It just becomes this gut feel thing. So we want to get rid of that subjectivity and make this a very objective feedback loop. So we have estimates, we have time and cost tracking. We align those things structurally so that the friction of asking the question, did we actually estimate this properly, is low. Therefore, we look at it frequently. And this creates kind of our qualitative feedback loop. Or sorry, this is quantitative, I believe. I'm getting these things mixed up. Bottom line is, this is data, it's objective, it's nobody's feelings. It's just, this is what we thought was going to happen, this is what actually happened. What that creates is a graph kind of like this, where we have effort, right? And most of the time we think about this in terms of hours, but maybe it's story points for you. Maybe it's some other measure of effort that you're using in your agency. And on this side, we have our scoping metrics, as I like to call them. And for most people, this is budget. But for you, if you have a very productized service, this might be like number of widgets the client needs to get built, number of pages on their website, number of blog posts they need you to build every month, right? It's whatever you're asking them in the discovery conversation to figure out, like, how big is this thing? How much effort is it going to take? And then as you track this data, you create this kind of relationship line of, as our scoping metric goes up, our budget goes up, how much extra effort does it take to get this thing done? And each project is going to kind of place a data point on this graph of, we charge this much and it took us this much effort. We charge this much and it took us this much effort. And over time, the more data we add to this graph, the more reliable that line becomes. And then what we can start to do is accurately estimate things without having to spend a ton of time on it, because we're using everything that we learned from all the projects we've done in the past to help guide this decision-making process and help us understand what is realistic, what is the relationship between, the increased amount of scoping metrics and how much additional time it's going to take us to do this. And the level of granularity that you can do this on comes back to the structure that you define in your estimate in the first place. If you're breaking things down by design, engineering, project management, that's the level you'll be able to look at this data on, because that's the structure of data that you're producing every time your team tracks time and does a project. And then from here, the way that we actually get more accurate, this is only the first part of it. This talks about the data, but then we have to talk about why the data is the way that it is. And I think the thing that a lot of people overlook is, a lot of times what we're trying to estimate is hard to estimate, not because we're bad at it, but just because the thing that we're trying to figure out is not that consistent, right? Our process is different every time. So this is where we start to have reports and meetings where we look at this data and we say, our project management time is all over the map, right? This project was way up here. This project was way down here. There isn't really a whole lot of consistency between budget and time that we spend. Why is that? What's going on here? And how do we make that more consistent? And this is where we can start to make process improvements based on those conversations that start to make things more consistent and make them therefore easier to estimate. And you can see these things are all connected. It's a feedback loop. It's a flywheel. You can bake this into your company. You can have your employees run this process, and it can happen on its own, and it can be kind of a self-fulfilling prophecy. And what those process improvements do is they basically place these rails down, and they start to limit the possible distribution of these data points on this graph. So it starts to push everything towards the center, make things a little bit more consistent, and this line becomes more and more reliable, and therefore your ability to accurately estimate things very quickly improves over time. And this is all happening as a result of things that you're already doing in your agency. You're already doing work. You just need to capture who's doing it and what clients they're spending it on, and so on. And you're already having conversations about how you do things, but now you can do that in the context of a more informed, more informed set of data, more informed information about like where the opportunities actually exist to get better and how much upside that could actually add to your business. So at a high level, that's how to think about getting more accurate at scoping over time, which again is something you do for yourself, not necessarily for your client. So you can make sure that you're not working overtime because you didn't think it was going to take that long and it's taking way longer, and you can have money left in your bank account afterwards because you don't have to pay people twice as much as you thought you were going to have to earn a certain amount of revenue that your client's giving you in the first place. That's pretty much the rant.
I got
drop the pencil.
Yeah, no, that was great. Jim had a question about time tracking, but I gave him a quick answer. But tell me what you think about agencies that do sell retainers. What is the good, what is the good strategy for these agencies to start time tracking? Why would they do it? And what are some first couple easy steps to start making time tracking a thing? Does that make sense?
Yeah. So there's a couple of things that I'll say on this. It's a great question. And I think that this is a fallacy that if you price flat rates, you price on value, you don't have to track time. And that comes from the belief that the only purpose of tracking time is to build a client. And the reality is the more important reason that you should be tracking time is because your labor is going to be probably the largest item on your P&L, like 100% of the time for an agency. Am I wrong, Ryan? Like that's how you earn your revenue. So it'd be pretty irresponsible not to pay attention to where that's going. It'd be like if you were in a restaurant, and you didn't know how much it cost you to make a plate of food. So that's why I think time tracking is important. Now, the only way to do it is not timesheets. Depending on your operational model, if people have very consistent work and they're not hopping from one project to another very often, or maybe there's not a whole lot of cross-pollination between team members, your resource plan could be a good enough source of truth for time tracking, which means that you can just create a resource plan and say, Jim's going to work on this for these 3 days, and they're going to work on this thing for these 4 days over here. And Mary's going to be working on this project flat out for the next 3 months. And you just kind of create these allocations. And as long as that's pretty true, and there's not a whole lot of updating that you have to do to that, you could have a single person, your project manager, creating your time tracking records. And that could be just as accurate as using timesheets and getting all of your team that hate doing this in the first place, putting that in individually every day. So maybe there's another way that you can be tracking time that doesn't put this burden on your creative team and instead puts it on the one person in your company that's actually excited about this, which is probably your PM or your ops person, right? And so they can blissfully go ahead and tackle that, and you'll still end up with the same output, which is how much time do we spend on these things, and you can structure it in the right way and still get a feedback loop on if your estimates were good or not. I hope that helps with answering that question.
That does. And Ahmed, a question too. Ahmed, you want to step in and ask that question? I've got a good answer for it, but I'm sure Marcel.
Sure. Thank you so much, Alex and Marcel, for the input. So basically, for my employees, I mean, I have a couple of them that are paid on hourly rate and a couple that are paid per fixed salary plus bonus. And they happen to be reluctant to track their time. Although I always tell them please track your time, but they just don't want to. And I don't want to be very annoying. So what is the best way to incentivize them to track time, or I don't know, have them do it?
Right. So it's a great question. And nobody likes tracking time, right? Nobody gets excited about opening up their time tracking tool, but we're all willing to do things that we don't like. Like I don't like going to the gym. I still do it almost every day because I understand the benefits that I'm going to get from it. And I'm willing to go through that pain in order to do that thing in the first place. So in this case, it sounds like they don't understand how that data is being used and how it impacts them in a positive way. And there's two ways that tracking time is going to significantly improve your employee's life. The first is that it helps you get better at scoping things. Because correct me if I'm wrong, Ahmed, but if there's a deadline and you thought it was going to take 100 hours to do this thing, and it's actually going to take 150, does the deadline move, or does the team just work extra hours to get it done in time? Which one of those things is more often true?
Team works more. True.
Right. And so they probably don't like that. They probably don't like working evenings. They probably don't like working weekends. Well, guess what, team? If you don't want that to happen, I need to get information. I need to get a feedback loop on if I'm doing a good job of scoping projects or not, because it's my responsibility to do that accurately so that when I schedule you to work on a project, it doesn't end up taking over your weekend, because we actually have a good sense of what it's going to take. So that's benefit number one. That should be enough to move the needle. The second benefit is, well, if we're making a lot of money, then we can pay you better. We can give you better bonuses. Like, I don't know how you compensate them, but generally when a business is very, very profitable, they're more likely to ball out on cool swag for Christmas and give people a better bonus and, put a soda stream in the break room and, have free snacks. Like, their life should get better if you're swimming in money. So that's the second auxiliary benefit. I'm not going to get into the details of whether or not their comp structure is tied to the success of the business, but even if it's not indirectly as a founder, like typically the behavior, if you're making lots of money, is you kind of want to share that love. And so it generally ends up trickling back. But the first and most important thing is this idea of scoping accuracy and how significant of an impact that can have on their life and their work-life balance. And you need that feedback in order to do that well. And I think the mistake that a lot of founders make is you start to use time tracking data. They start to weaponize it to figure out who's working hard enough and are you hitting your utilization targets? And like, that's the reason that people stop using it. They start resenting it. But if you can avoid the urge to use it for that, and instead use it to have really productive conversations with the team about like, how do we get more accurate at scoping? How do we get more efficient at getting these projects done so you're not working overtime? That should be enough to get them bought in.
Makes sense. Yeah. Sounds good.
Awesome. Great question.
Yeah, very, very good. Very good. Okay. So yeah, and I was just going to add my personal experience to that, Ahmed, and I did have a bad experience with a consulting relationship that I had that I was on salaried for, and then they presented this screen monitoring plus time tracking software that they wanted me to use. And that definitely muddied the relationship. And, it ended shortly after, of course, but there's ways to do it, especially if you are the boss and you have contractors as well as salaried employees. It's just one of those things. It's like, as an agency, you got to get better, which means you got to get more data. You've got to know what's going on internally. And in order for everybody to make more money, we all have to know what's going on, right? So it's kind of like one of those things. It becomes part of the process. Anything there? I mean, Harvest, what is Harvest? I actually haven't used Harvest, full disclosure, but what is Harvest? Is it screen monitoring and hours, or is it just hours?
No, Harvest doesn't have any screen monitoring. I really I don't care what time tracking tool you use. Let's be honest here. Like, any time tracking is better than no time tracking. When we talk about picking the right tool, it comes down to three things, in my opinion, three important things. The first is compliance, right? Like, your time tracking data is not good if it's not there. So you want to make sure that your team is actually going in and inputting that data. And that really just comes down to reducing friction. So, as much as it seems arbitrary, like having a nice clean UI that's beautiful, that's easy to use, that's fast, that loads quickly, that you can put in your Chrome browser or put on your phone or having all of those options, which Harvest has a lot of, it increases the likelihood that your team is going to find a way of tracking time that they can actually stick to, right? And they can build it into their habit and they can do it consistently. So compliance is number one. The second thing is accuracy, right? So can you structure tasks inside of your time tracking tool that make it easy and clear to your team where they should be putting their time? So they don't end up just like sticking it in a random place because they don't have clarity on where it's supposed to go. That again ends up giving you data that's not that useful to use. And so it's important to make sure that the tool can be configured in such a way that your team finds it easy to not only input their time, but put it in the right place. And then the third thing is structure. Does the time tracking tool allow you to architect on the back end the structure of that data so that it aligns back to your estimate? If those three things are true, then that is the right time tracking tool for you and you should go use it. It doesn't really matter which one it is. I like Harvest because it's typically good at those three things for almost any organization. So that's part of the reason that we're partial to it. But again, it doesn't really matter what you use. I want to touch on a question that Jim asked, which is scope first, price second. Great question. Yes, basically that is generally my advice. Like, you can't give a client a price until you know what your cost basis is. Now, your price doesn't have to be contingent on that. Like, if you're pricing on value, you might ask for way more money than it's going to cost you to do the project, and that's okay. But you should know what your floor is when you go into a conversation about price with a customer, so you don't end up either losing money or making an unsustainable profit margin on a project that's especially true when you have lots of opportunities in your pipeline. At the end of the day, having work is better than having no work. Like, utilization is always your first priority when it comes to profitability. You have to make sure your team has work to do, even if it's not paying you very well. But if you're in a situation where you've got consistent pipeline and you could pick up other work, then you want to make sure that you do a scoping exercise before you talk about price with a client, in order to have a sense of what is the lowest amount of money that we can take for this project and still hit our goals. And of course, if you're doing flat pricing and it's kind of a standardized list, then you should certainly be doing that work before you set those standard prices, so that you have a sense of what that margin looks like. So good question, Jim. Yes, generally speaking, scope and then price.
And I'll just add one quick thing. I bet you talked about it and I may have missed it, but insurance too. So if you're planning on raising prices, and two sides to this: insurance for when deals go wrong. Like if a client has a major issue and they're coming back to you like, hey, this, you didn't do this and that and whatever, you have that data to say, no, we did. And it was booked right here. And this is when we did it. That's one thing. But then the opposite side of that is if you are gearing up for a price raise, which, as we learned from a couple of Jason Swank's sessions, you should be raising prices every 6 months. If not, you're really not getting better as an agency. Look internally and figure it out. But hypothetically, you've got a price raise in 6 months. What you're going to need to do is benchmark and then get the data to support that price raise, to say, we are actually getting better at these services, which is dropping hours. That could be happening. Or client demands are becoming higher because we're seeing more hours get tacked on. Or you may have hired someone that is more efficient than the previous. So you're benchmarking two sides. The internal operations is the agency, how much better and faster and all that stuff you're getting. But then the other side of the benchmark is what's happening with client services and how much of the demand is changing on your agency. So I just wanted to add that.
I'll add to that, Alex, by saying, like, we get this question all the time. What should I be charging per hour? What is the right average billable rate? What are other people charging per hour? And the reality is, like, it doesn't matter. None of that matters. All that matters is what is the difference between what you charge and what it costs you to earn revenue. It's margin. So when you're hiring more senior people, and that's, elevating the level of your creative, elevating the types of solutions you can offer to clients, that in and of itself is justification for raising your prices, because you need to maintain this healthy margin if you're to run a successful business and be able to stick around and keep serving your clients going forward. So even just saying, yeah, we're hiring senior people, they're more expensive, therefore we have to charge more. That's all it really takes. And your price, your hourly rate, whatever it is, all that really matters in this context is what is the gap between that and what it costs you. And the cost is generally going to be mostly your people, the people that you have doing the work.
Awesome. That's great advice. So it doesn't matter what prices are.
Ahmed has another good question that I'll answer here. What's a healthy margin in the agency space? So I think about this in two ways, and I'm going to talk about this purely in relation to your agency gross income, because I think these numbers can get really weird when we start talking about gross revenue, because one agency might do $10 million in a year, but they spend 9 of that on production. And so they're actually only a $1 million a year agency. So those numbers can get really strange. So let's normalize it and say, as a percentage of your adjusted or agency gross income, I shouldn't say adjusted, I know that's an accounting term and I'm not using it correctly. Agency gross income, 50 to 70% should be a gross margin target. So again, that's looking at, after you've taken out pass-through expenses, how much did it actually cost you to earn that revenue based on the time that it took your team or your contractors to earn it? And then net margins, like most people in the industry, are around 10%. I think any healthy agency should be anywhere from 20 to 30%. I've seen agencies higher than that at 40%. That's usually a sign that they're either exploiting their team or they've just really found a lot of efficiency in delivery. Maybe they're arbitraging another economy where people get paid less. Like, there's ways to stretch that gap. But like, if you're 20 to 30% net margin at the end of the year before taxes and distributions, that's healthy. I like that. So typically what you're looking at is 50 to 70% gross profit or contribution margin on your projects. And then your overhead is going to be anywhere from 20 to 30% of your agency gross income. And that's usually broken down by about 4 to 6% facilities rent, about 8 to maybe 12% administrative costs, legal, accounting, et cetera, admin assistant, and maybe another 8 to 12, 14% on sales and marketing. And then it's your choice after that. If you want to reinvest a bunch of profit into growth, go for it. But like, if you were not making that choice deliberately, operating the business under normal conditions, that's probably about the ratio of your, agency gross income that you're spending in each of those buckets.
And I'll add to that 50 to 70% is a pretty big range, but think of it from what is your target net profit. So if your target net profit is 20%, then it really depends on your cost structure. If you have more overhead, then you need to have a higher gross margin. If you have really thin overhead, if you don't have a physical office, et cetera, then your gross margin in theory could be lower. And so it's kind of, okay, start with what's my net profit that I need to make this a worthwhile endeavor and pay my taxes, et cetera, and then kind of work back to say, okay, what then is my target gross profit based on that?
Yeah, and big fluctuations between target verticals. So you could have a digital marketing agency that focuses on manufacturing versus healthcare versus pharmaceuticals versus B2B SaaS. So it's not so much, in my experience, the types of services, but the vertical that you're selling into. And obviously going into mid-market and enterprise, I see agencies telling me the margins get larger. Of course, that makes total sense. And a good example of that, Ahmed, is we know an agency that's in the pharmaceutical space. They contract PhDs at $150 an hour. They immediately sell that PhD's time for anything, research, document creation, even editing, basic editing, for $350 an hour immediately, right? That's only doable in that space. You can't do that in manufacturing because why? How could you? There's not that level of thought expertise needed. So just understand that. What is your space though, Ahmed? What's the vertical and service? Ahmed, you there?
Yep. Email marketing, he says. E-commerce email marketing. Yeah. So like you should be able to land, part of this comes down to value. So I don't know if you typically work with SMBs, mid-market or enterprise type companies. Like that's going to, potentially have an influence on like how much of a premium you can charge, how you can start to anchor pricing. But like you should be able to achieve 20 to 30% net margin in your industry. That is not uncommon based on what I've seen.
Yeah.
And that depends on size a little bit too. So usually, that's kind of a good starting off point. As you grow, you're going to need to you'll find more overhead because you need more project management and more tools and people management, leadership team, and all of those people won't be directly billable. So that's really going to, as you get to that kind of 10, 15, 20 people, your net margin is going to be squeezed quite a bit. But then you're setting yourself up for future growth and bigger margins down the road. So it depends on where you are in your agency life cycle too.
Yeah, to Ryan's point, like you are going to make conscious investments kind of out ahead of your AGI growth in some cases. And so, yeah, to your point, like you might bring on a full-time hire that, pushes your admin cost up to 20% of AGI, but that's with the understanding that you're then going to grow into a new AGI level, and that'll hopefully come back within kind of the boundaries of what we think is acceptable.
Yes, sir. And then just partnering with a different tool can add to those margins as well. So think about if you're 100%. Partnering with OmniSend, you're in a different bucket than Klaviyo. If you immediately switch to Klaviyo and start learning that tool, you're going to immediately sell into a different type of website, and margins will immediately get higher. So if you're looking to supply a strategy to this, there's a number of ways to cut it, but you can look at different ways to add some gross margin. But I think data, understanding how you're going to talk to your clients about your pricing structure and strategy is super important. That could be its own thing. You guys, maybe we kind of tease it a little bit in each session, but how should these agencies be talking to their clients about how they created their pricing structure and how they monitor it? That we don't have to answer that now, but maybe we have like a little 10-minute class on that if you have a good answer for it. I don't, but if you do, I think that could be one. But Ryan, let's do this before we go. I'll give it back to Marcel at the very end. But Ryan, why don't you tell us what's going to happen in the next session? We're going to talk about accounting, payroll, anything specific for takeaways that you mentioned?
Yep. So we're going to spend, well, I mean, it could be 8 hours, but we're going to compress that all into 30 minutes and talk about all the, kind of nuts and bolts and tools that you would use to just kind of help your back office and, help you, spend more time, with your clients and on sales. And so whether that's, cloud accounting systems and automated payroll systems, accounts payable, invoicing, and just kind of tying that all together so that you're not sitting there, collecting all your receipts and entering your information on the weekends to get everything for your tax accountant at the end of the year. And then also, how those things inform good decisions. Like all of this, Marcel was harping on, you got to have the data there. And so you've got to have systems set up to give you that data. Otherwise, you can't make good decisions.
100%. And we had someone posted about insurance as well. We have some recommendations there. So that could be a good time to bring up insurance questions, possibly if we just want to recommend what to do. But we'll do that in the next session. Marcel, you've been awesome. I did say it was 30 minutes, but we did go into some questions. And I think we got some really awesome stuff. So as usual, this was awesome. Where can they find you? Post some links. Anything else? Let them know.
Yeah. I guess I'll go back to the screen share. Yeah. So if you're interested in just like doing some of this modeling for yourself, we put together a pretty crazy spreadsheet called the Agency Model Generator, where you can just put in the people that are on your team, how much you pay them, how many hours a week they work, what your average billable rate targets are, and it will help you figure all of this out. Budgets for overhead, admin, sales and marketing, what your net profit, gross profit targets should look like, your utilization targets, like all of that. It's pretty incredible. We started selling it, but I'll give it to you guys for free. So if you want that, just head to parakeeto.com/toolkit. You can get access to that. My information is there. Come find me on the internet. I'm wearing this shirt everywhere. Happy to be a nerd and talk about all of this stuff with you anytime. And thank you for being here and listening to me for almost an hour talk about the most boring part of running your business.
I love it. No, that was great. I think this is super exciting. I think pricing is the most exciting part because that's where money comes from. Let's be honest. But yes, I'm changing accountants, by the way, Ryan. So I'm going to have my own questions for next session. Thank you guys both for the time. I'll let everyone take a bathroom break before your next meetings. But thank you again. Take care, guys.